Good morning and welcome to the EQTEC PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and we'll publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Geoffrey van der Linden, COO, Nauman Baber, CFO, David Plumbo, CEO, and we'll shortly be joined by Dr. Yael Elman. Good morning.
Good morning. Thank you, Paul. Welcome everyone to the half-year 2022 results update, investor meet company presentation. We thank you for joining today, and we're going to go through the financial information of the half-year results, and then we're also going to give you some of the rehash on the strategy of the company and give you the outlook that we see going forward in the market.
From a revenue perspective, we recognize around 2.98 million worth of revenue. This is 6 times what we had recorded in the first half of 2021, and it shows the maturing business rhythm whereby we are pulling more and more revenue towards the first half of the year and trying to reduce the lumpy nature of the revenue in the second half of the year. The gross profits was up 0.24 million versus 0.07 of first half of last year. Although in an absolute term, that's a higher number as compared to the first half of last year. However, from a gross margin perspective, obviously as a business we have had some headwinds from a supply chain perspective, which we are trying to mitigate and manage. The EBITDA loss is down as compared to the first half of last year, 1.97 recorded first half of 2022 versus 3.49. What it shows is that we are heading in the right direction because as a business we have an aspiration to become EBITDA positive. So we're reducing the costs, refocusing the resources where they're needed, and also we are in the process of actually recovering more costs from our project than we did before.
In terms of commercial and operational updates, we've been speaking about the importance of the market development centers. I will expand a bit more on that as well. We have 2 of them progressing towards a key milestone. I mean, we have Italy being commissioned in year, and we have the other 2, Croatia and France, progressing very rapidly post-period as well. In terms of the UK, the RDF projects, we have continue to move ahead the project and progressing with top-tier partners as well. We have been shifting the development liabilities, and we're moving more into our core expertise and of being the technology provider and providing development services, and being less involved in the investment around the development of these projects. In terms of contaminated plastic from an R&D point of view, I mean, we have now provided the ability and have a solution for contaminated plastics. And also we have a partnership now to develop liquid fuels capabilities with the partnership with Compa GTL. So we're adding these 2 new solutions to our portfolio, and we look forward to develop also the reference projects into these 2 type of applications. From a point of view of project finance, acceleration and project development, we are focusing the project where they have a ready ability of either project finance being secure or an off-taker or an operator interested on the project on commissioning. So we make good progress in the Greece project, and we make good progress in the UK, particularly with as mentioned before, the sale of some of these SPVs or the transition of the development liabilities to the original partners. And the US as well, I mean, we had positive funding offers for the second project in the US, and at the same time we are also addressing funding options for the completion of the Norfolk Community Power project. One important thing that we have obviously spoken is the importance of the Market Development Center. I mean, the Market Development Center, as we expressed before, they are a commercial scale plant functioning that are profitably in their own rights, but they also prove not only a live setting plan that you can take stakeholders and you can catalyze demand for this type of project. But more important is something where we could also prove business models. We can also prove business model in case of what is the offtake, what is the application, and what are the commercial relationship and the commercial demand for this type of plan. So in terms of building blocks of a strategy, this is one of the most important as well. I mean, has been very good for demand incubation. Having the R&D plant in France, but it's very different when you have a plant that you operate, and we can take our own stakeholders and customer and strategic partners for training, to accelerate and catalyze funding as well. I mean, in Italy project that will be commissioned this year, we have a number of infrastructure investors and funds that have been all waiting to get this project commissioned as well, and they are looking to take a portfolio approach on the funding of our pipeline. But obviously, the first plant being operating that they can see day in, day out, and they can send the teams to do a technology review on a real life setting and not a desktop review of the technology will be very important to catalyze demand. And if you want to comment more on that.
Yeah, I think I would just comment on the progress we're making. I mean, as David has mentioned, there are 3 market development centers that we're moving ahead on, and there are others that we have an eye on in the future. For now, our sticking to the knitting is about getting those 3 up and running. Italy by the end of this year, Croatia as soon as possible after that. And I was 2 weeks ago at our MDC in France. I hope to publish soon a site video of that visit as well, so you can get a closer look. But that plant is very exciting. I think many of you will know it's a retrofit of a failed technology there. Yoel, the CTO, and the team will be doing their visit as well and mapping that whole site and looking at precisely what it is that they're going to replace. I think they already have a very good view on that. But it's a very well-built facility. It's got very good foundations, very good steel structures, and a very good room control building that also holds the engines and so on. And it's also located within the middle of a much larger facility where we will be receiving mixed feedstock. So again, the other thing I'd say about this market development center in France is it will be a demonstration of another facility, but one where we are mixing 2 types of wood waste, one contaminated, and then a third type, which is RDF. And all 3 of those will go into the same plant, and we will be able to produce feedstock from that. That dramatically differentiates us, and it gives us another type of development center.
Yeah, I think what is important there as well. This is when we're talking about a mixed feedstock usage in this plant in France, is also a plant that, having had all the development done and all the civils already done, is a plant where we can prove at commercial scale RDF much quicker than the larger projects in the UK, but it's still at a scale that is important. This is at 30 to 40,000 tons a year of mixed waste, including RDF. In the case of Italy, it's agricultural waste with the production of biochar. That's a very specific application. We're getting a lot of interest now, also in Europe, like originally was in the US, about biochar selling to anything between 800 euros to 1,000 euros per ton. And then in the case of Croatia, this is an industrial setting where we're taking a portion of industrial waste and we're providing heat and power to an industrial customer that is right next. The industrial customer will have demand for more capacity, so there's an opportunity as well to scale up Croatia from 1.5 megawatt all the way to 4.5 megawatt.
So this is something that we've shared before in a slightly different view. We talked about the importance of transforming the business model of the company from being one focused on project by project, one-time revenues, to one where we are earning recurring revenues. And inevitably, those are going to be as much or more at the back end of the life cycle, by which we mean through construction and commissioning into operations and maintenance, as on the front end. And of course, right now, given where we are as a business, we're still very focused on developing projects to move forward. But as I think you will have seen in the interim announcement now and some of our recent communications, we are already taking steps to move in this direction. We are, as David was saying a moment ago, and Noman as well, starting to pull out our direct investments in that development, as much as we are still exerting our influence and indeed expertise on developing these projects successfully, we are not putting our money at risk. And increasingly, we are looking for other investors to take these projects forward and allowing them to invest in these. Towards the long term, which as David was just saying, we see not only having project finance come in, but also owner-operators themselves buying our plants or indeed portfolios of our plants. This continues to be the strategy, and one by one, we will start to do this. Another key thing that we've done is that we have unbundled the pricing, which again, we've talked about this before. Previously, our model was such that we did not recover a lot of our engineering and the technology and innovation fees until financial close, when we would start billing for the technology. What we've now done is we've unbundled those, by which I mean we are starting to charge for early stage, for example, pre-feed engineering services, feed engineering services, front-end engineering design services, all the way through up to financial close. So we're starting to bill and invoice earlier and more often. And that, of course, is going to help us with cash flow and help get that cash into the company that we can use to reinvest. So we are moving along this journey. As David has said many times, the strategy is the strategy, and we are still pursuing it. And you should start to see an increasing number of these types of activities that move us in this direction.
Continuing the strategy execution, I mean, we have often spoken about the important building blocks for our strategy. So, as Jeff alluded before, yes, there's been, and Numan as well, there's been some headwinds in the market. I mean, it's impossible to not see it. I mean, it's happening, on a daily basis. We get news about, risk off in the market, et cetera, and the availability of capital in the market obviously is significantly reduced. Having said that, we have a number of strategic outcomes or milestones that we need to achieve, and the advantage to our strategy is that we could still choose what gives us that strategic result, that catalyze, what is that market development center? Okay, instead of doing 3, we can choose to do 1, but the effect of having the market development center is the same. The same goes to SPV cell. How many will I sell? 1, 2, or 3? It doesn't really matter. The SPV cell will prove then the demand for a buyer of the development asset. The same thing goes to the refinance of a project. So if you look at this table, it's literally the building blocks of our strategy and how we every year are filling more of those, strategic outcome or milestones. In terms of market development center, we already commented this. We go Italy, Croatia, and France on a very good footing. And we have, already have identified what could be the market development center in the UK, doing RDF to hydrogen, and possibility as well in Greece and the USA. In terms of the go-to-market, although we also comment recently that we are taking much more of a, focused approach to looking at which projects are strategic to us. We still, are working through go-to-market partners or go-to-market subsidiaries. Croatia has been, established now for a while. Greece as well. France is the earliest one, the latest one to be established, but it's also the one that have yielding very rapidly results. And one of the reasons for that is having Lorraine as a RD facility where people can go and see. And now when we have a larger plant like a market development center, we expect France will catalyze a lot of demand both for funding and all the strategic partners in Europe wide. When you look at the technology, you can tell that we've been filling the buckets as well of applications. So we have our pipeline originally was mainly about biomass to power. We now have also RDF projects that are well developed, close to financial close to construction, like the one in France again. And then we also start bringing our solutions like the ability now to in Lorraine to produce synthesis gas to be analyzed for hydrogen production, for synthetic natural gas or biofuel production. So we are very happy now how the technology, we have enough of the reference plan to position ourselves like the world-class technology in the synthesis gas for all these applications. In terms of the project as well, we are now start proving different business models. The small local community, selling to the grid, the US type of environmental remediation type of project with biochar and the removal of forestry waste. And then you can see now industrial applications like in Croatia as well. So we are proving also different business model and different structures for, who are the potential off-takers of this plant and who are the interested buyers or operators of this plant as well. And in terms of partners as well, the more project we develop in partnership with some of our top-tier partners, like Energia, Wood, Black & Beach, Petrofac, and the conversation with all the other partners, now are seen as well as being catalyzed by the Market Development Center, by the application of the technology and the business model. So all of this is start building towards, a strategy where we have more and more potential licensors of our technology, but also more and more demand for owning this new energy transition infrastructure that we are building powered by the EQTEC technology.
Yeah, if I can just comment on something that David said a few minutes ago, we are a technology company. And our intent is to become a dedicated technology company focused on innovating at the front edge of the technology capability and licensing it to as many places as possible. If you think through what that looks like in practice, therefore, it's not about project A needing to be the next project or project B being the next project. We need a project that gets our technology demonstrated in a specific environment as quickly as possible. And as we look at project execution, and we'll talk a bit more about that, no doubt, when we go into Q&A. When we look at project execution, there are some projects that start to slow and others that start to pick up speed. And our focus is on devoting as much energy as we can to the ones that are going to go fastest to close as quickly as possible. There are those of you who have had experience and so on in large-scale infrastructure investment and construction and so on know that there are all number of hurdles, more so now than perhaps in the past, given a number of conditions in the post-COVID world. But with all of those, wherever we can go the fastest, whichever projects will advance the furthest, most quickly, are the ones that we turn our attention to. Because our interest is having our technology demonstrated in those facilities, not necessarily in having a project or any specific project done in a specific period of time. And so that is exactly where we're focused. These are the routes to market for this technology, and we will push them as far and as fast as they're willing to go.
Talking about the look ahead effectively, so from a financial perspective, what we are focusing on is to ensure that we bring more cash into the business, and that is being achieved through kind of three-tiered strategies. So first of all, we are refinancing the projects which will reach commercial operation, so that the loan or the equity that we have invested into the project, we're able to recoup that back. The second is more around the SPV sales. As David mentioned earlier, we are bringing the UK RDA projects to a point whereby there are interested parties to actually take the project on and take it to financial close and then to construct. So that would unlock a lot of capital, both in terms of development service fees and the equity that has been injected into the projects. And the third element is more around the unbundled pricing, which Jeff alluded to earlier, to ensure that we are bringing in, we are invoicing much earlier in the process for the services that we are providing, pre-feed, feed, and before financial close. The second element is more around the revenue and bringing more, certainty and sustained growth from a revenue perspective. So we are being very, very careful in terms of the projects that we are deploying capital to, what they catalyze in terms of the demand, and how it would translate into revenue. There is a lot of planning which goes behind thinking through these projects and the type of revenue that we can get from that. This also includes the fact that soon we will be moving more towards the technology licensor piece, which we have been talking about as part of our strategy. And from an SPV sale perspective, I think there are two key elements to it. One is once we are executing these deals, we are proving the capital-light nature of the model. And two, the development capital which EQTEC has been deploying so far on these projects, we want to shift those liabilities to other interested parties who want to take that development risk and the upside in association with that. So all in all, shifting liabilities, ensuring capital-light nature of the model is actually implemented and moving more towards the technology licensor part of our strategy, which is our end goal.
In terms of commercial and operational, in terms of outlook, we discussed this already. Technology, will continue to push new applications and continue to be at the leading edge of synthesis gas technology. So we will be able to take all technology partners, before year end to test or synthesis gas for the hydrogen production, for the biofuels production. The R&D facility has had a lot of activity this year. Will continue to have a lot of activity with a lot of stakeholders engaged in that activity. In terms of the innovation as well, we will have now RDF as a priority in the plant, also in France as well. So we'll accelerate RDF solution for combined heat and power, but also RDF for the production of hydrogen, like we're looking to do in Southport. And that's very important because we'll be very soon able to give a levelized cost of the production of hydrogen that is an alternative to electrolysis, and we'll have a very interesting price point as well. In terms of the pipeline, the important thing is now this is all about being more attractive and accelerate the relationship with the strategic partners that will scale our pipeline. And those strategic partners are typically of the form you'll see in our discussions are with other industrial partners to build in their own premises or type of infrastructure, utilities to build the infrastructure and then sell the power or the fuels to the industrial partners, infrastructure investors, energy transitions investors, and municipalities. In terms of the project, again, we will continue to focus on the projects that are funded, that are permitted, or they are coming from some of the strategic partners where already the heavy lifting will be done from the partner. And in terms of the partners, we'll see coming in the next months more tier one partners, both from the point of view of funders, advisors, EPCs, developer, and we'll make sure that we keep the market informed with all this exciting development going forward.
Fantastic. Thank you very much indeed for your presentation. Ladies and gentlemen, just while the team review those questions that have been submitted already, I'd just like to remind you that the copy of the presentation along with the published Q&A can be accessed via Investor Meet Company dashboard. Perhaps before we go on to some of the questions we had during the meeting itself, we did have several pre-submitted questions, and if I may just read those out to you to start with, and then I'll hand over, Jeff, if I could, to you just to take any of those questions through the meeting. The first one reads as follows: the results point out that your H1 revenue this year is much healthier than last year. Why the improvement?
So I think the improvement, first of all, it's as I mentioned earlier, it's all about the maturing business rhythm. So bringing the revenues earlier and moving away from the lumpy nature of the development service fees and other aspects that we see of. So we have been carefully ensuring that we move towards, and I don't think so we're there yet, but we're moving in the right direction. We move towards a point where it's a more the market has a clear understanding of the first half revenues and the second half revenues, and not everything is coming in the second half.
Yeah, I think it's, as Numan said, is the maturity of the business as well, and the fact that then the fees are more distributed because also you have more demand for your services because all services have been validated already by project that we have developed. So now we're seeing some of the strategic partners, some of the larger developers, operators coming to us saying, you don't need to advance the capital, we'll pay development services fees for you to develop the project with us. And also what Jeff was mentioning, that we're focusing more on the real value added that we bring in terms of technology expertise, and let larger developers dealing with the, let's say, commoditized or non-differentiated part of the development, like planning and civils and things like that.
Thank you very much indeed. Next question we've got here is, why is it taking so long and requiring so much capital to close projects?
Well,
there are a number of reasons why these things take long. We look at 4 different things when we develop any project. Funding. We look at the commercials based upon a financial model that makes sense and that delivers a double-digit IRR unlevered. And those financial models now are at a level of sophistication and we believe robustness that we're feeling increasingly confident. And we're getting that kind of feedback from people who are taking a look at those as well. So the funding and the commercial. We also, of course, look at the technical and the engineering. And of course, that involves not just our own core technology and engineering in which we have great confidence and faith, but it also involves the engineering and the capabilities of our partners. And so, for example, Wood bringing methanation technology and hydrogen technologies. We've recently announced Compact GTL. Sorry, our lights are turning off here. We've also announced Compact GTL, and we'll announce other, technology partners. Energia, of course, for anaerobic digestion and for, sorting and MERV technology. So that technical and engineering component is a third one. The fourth one that we look at is the planning and the readiness to deliver and construct the plant, with the quality we want. We are supremely confident in 3 out of 4 of those. Certainly the technology and engineering we are. We are very, confident in the delivery readiness part of that. And as we bring in, some of the partners that we've announced recently, Petrofac and so on, who are coming to work with us, Black & Veatch on D side, we are even more confident of that one. The commercials, as I say, we've spent a long time really getting in all of the insights we have and the understanding we have of how the market dynamics, so that we can have very strong financial models, so that we can negotiate the feedstock contracts, the offtake contracts, the disposals, the O&M, and so on into that. And we're feeling very confident there about that. And so you can tick on most of our on most of our projects, all of those boxes. We've made huge progress in pushing those forward. And then lo and behold, COVID happened. But coming out of COVID, even more importantly, 2022 happened. And that kind of snowballing effect that we knew would happen in terms of revenues, such as Noman was, commenting on coming out of last year, we suddenly hit a market where that snowball was not going to grow as fast and at the pace that we thought it would. And funding, that one outstanding point, is really what has proven to be the most difficult. Not because it's not available, but because that funding will come from very specific sources that we have to do a much better job of targeting. And we also have to compete with the same number of people going for a much more specific set of pots of that funding. And that has really been what has slowed down the projects more than anything at all. It doesn't mean they've gone away. Quite the contrary. We still have got a very strong pipeline, and it's growing. What we now have to do is execute funding excellence with our partners, without the liabilities that the guys were talking about on our books, and pursue that, with much stronger nous than perhaps we have in the past.
I want to add to that as well. I mean, slowing speed is a relative point here as well. I mean, we need to see, we are benchmarking this against what? I mean, if you look at this type of size of projects being built, even incineration plants, which are a proven technology, how many has been built in the last 3 years in the UK? If you look at refineries, if you're looking at even some of the battery parks, these things take 5-10 years to develop some of them. We are, in fact, given a resource base as well, we are advancing development very rapidly. For us, it's more important than for anyone else, because a large infrastructure player can slow down and accelerate the development of a project. Like, no one now is building anything because it's very different to price, cost of construction. No EPCs is giving you a fixed fee contract at this stage. So when you have a portfolio and you are a big, owner operator infrastructure, you accelerate and slow down when you need to address the market. I mean, we don't have that luxury because, we are in the process of validating ourselves. We're a small cap company in the public markets, and we constantly need to be showing progress as well. But I think the speed of which this project has been developed, I mean, you look at the amount of work that has been done in this site, commercially and design in the space of 2 years, is incredible, with the resource that we have had. Same thing in Billingham. Billingham has been working for years. It's been reconfigured, it's been changed. So I think slowing down on speed is a relative term, and we need to benchmark it against similar infrastructure and seeing really what is being built in the market in this environment.
Thank you. Next one we've got here. Does the update and guidance indicate that project opportunities are weakening? If not, what's behind this?
So I think we definitely don't see the demand weakening or the projects kind of falling off. What we are doing is we are making a conscientious decision around which projects to pick and which serve as catalyzers for us with the deployment capital that we have. So ensuring that whatever capital we have, it goes a lot further than it normally would. So if it means that we are shifting some of the projects out to the next year, so be it. But we will ensure that everything that we deliver is aligned to our strategy and validate those data points.
Absolutely. I'll add context to that as well. I mean, in a model where we were being very protective about not advance cost on projects for the supply until the project was fully funded. We are in a market now that is impossible to fix a price if you don't buy in advance from your suppliers, and you lock a significant amount of capital to be able to deliver that revenue, to recognize the revenue, but also to be able to deliver that equipment on site. The more we move away from the procurement ourselves with strategic partners or licensing, the problem goes away. But this is a problem that large, supply chain managers and procurement companies, like big EPCs are facing. We have a lot less buying power of them. We need to pick and choose which suppliers will have the relationship where we can use our capital to maximum efficiency, like Numan is saying, and then we need to make the certain adjustments to be, protective to that market headwinds that we're facing. And as we say in an interview yesterday, we don't think this is going to improve in the next 3 to 6 months. So we need to make adjustment, and we need to be resilient enough to run this path for the next 12 months, because the markets are going to be pretty tricky for an extended period of time.
That's great. Thanks, David. Next one we've got here. The company has made substantial investment in North Fork, the UK projects and others. How will it get its money back?
Great. I can answer that.
Well, I was just going to say, I mean, the straight answer to that for all of our projects is that no matter what we do, no matter what arrangements, and you'll have seen this with our Southport announcement, with the D-side announcement, the very first thing we do is safeguard and contract for charging the development fees that we are due for all of the investments that we've made. So these are not write-off situations where we're looking at losing money or capital that we put into it. Quite the contrary, we will safeguard that, and we will bill fees, which will bring us some margin as well.
The answer to add to that is exactly what we will do. It's either a sale of the SPV, where we have a secure charge on the SPV, or it's a sale of the asset when it's operational. In the case of Norfolk, obviously Norfolk has faced any challenge that you could imagine, and now the discussions are to get Norfolk commission, with someone else, covering the gap. And for us, Norfolk value is to have a plant operating in California, but that has no implication in our revenues anymore. But it's something that we want to have there to be able to catalyze the remaining pipeline that we have in the US.
That's great. Thank you very much. Last pre-submitted question we've got here. You said that in the past the company is more valuable than ever. What's the basis for that statement?
Yeah, I think I said that one, so I'll take that one. The company is in terms of, we're talking about value versus stock market valuation. The value is in the fact that we have a very mature pipeline of projects. We have a secure pipeline of projects that now are very, close to financial close. Some of them have been built. We have much more assets from a technology point of view. We have stronger IP. We have stronger know-how. We have a very good team that has been now galvanized in a tough market, which is what you want from a team. You want a team that has the strength to withhold the different market situation, and that's and we have the commercial infrastructure and the relationship. All our strategy, all the building block of a strategy, that slide that we were showing about, is being continue to pursue at different speeds, but continue to pursue. I mean, we are in an environment with most companies that need to go backward. We are just slowing down, and it's fine to slow down, and it's prudent to slow down to be able to then accelerate when the market and the strategic environment allows us.
Fantastic. That concludes those pre-submitted questions. Jeff, if I may just hand over to you just to click on that Q&A tab, where appropriate to do so. Just read out the question and give your response. And of course, any questions that we don't get around to answering, the team will be able to review those, and we'll publish responses where appropriate to do so. Thank you, Jeff.
Yes, thank you very much. I'm just looking through them now. There's a question here about how are you keeping control of your projects and ensuring that EQTEC are still going to be in the picture, for instance, with Southport. If I could make some general comments, and then maybe David, you want to follow up on Southport as well. But it's a very pertinent question because of what we've described here as being our shift from being the owner of the project and trying to have others be the owner of the project, and us simply being a supplier to that project. We still have a very strong interest, of course, in the quality of the work, in the timeliness of the project management, such that we do not want EQTEC technology to be associated with projects that are over budget, over time, or indeed failed altogether for things that don't have to do with EQTEC. So it's a good question, in terms of that. The most critical projects for us are the MDCs, where we do stay very much in control on those, and we do that with intent, because those are the showcase facilities that we will very proactively want to use as demonstration facilities for a range of potential customers, partners, and other stakeholders. But even on the projects such as Southport, as you mentioned, or Deeside, or those in the UK, we still have a very strong interest in staying involved. And in every case that I can think of, the potential, the investors who are looking at this, the funding sources that are looking at this, want us to stay involved. They want us to be very actively part of the team. They want us to sit on the project boards and continue to be actively involved in it. But as we move over time, we want to become less and less concerned with needing to be in control. And bringing in some of the partners we're bringing in and some of the big names we're bringing in helps to stabilize those projects and give us confidence that we don't need to be in control. If a Black and Veatch comes in, for example, or a similar quality company comes in and takes over as the EPC, there is not a strong need, we would say, because we've pre-qualified that partner, we've built the relationship, and they have a very strong brand and a strong track record for delivery. And so again, that gives us confidence that that project will continue without our deep engagement beyond the core technology and engineering, and it will still mitigate the risk that that project could go south. And so over the long term, our plan, therefore, is to start working with bigger and bigger and better established companies that mitigate any risks that the project would not go where we want it to.
Well, specifically on Southport and some of the project, even this side. I mean, there's two ways that we protect that project in the pipeline. First of all, our fees is a choice from us, the fact that we maximize the development services fee instead of the equity portion of that, because that's the way the structure of our business model is. In this side, we will sell the SPV, but we'll still be one of the biggest creditors of the SPV, and we'll still have, typically by the way of development agreement, or typically by the way of the fact that we have developed a project here and have all the data will be involved in the development, continue to be involved in the development. In the case of Southport is completely two separate projects. Southport is not integrated like this side. Southport, you have an AD project, and you have the gasification project, which is the RDF to hydrogen. The AD project was only developed as a mean to an end to access the second site. Now that project is being developed, that someone else can finish to develop the AD plant and commission and build it, because there's no other than our secure development services fee on the project, which is secure by a secure convertible note. We have no revenues associated with that project anymore. All our interest is in the RDF to hydrogen. So we are secure on this project either by a way that we are the core technology, all the planning and the design and the financeability of the project depend on our technology, or we have a very specific legal arrangement, which through a development agreement or a secure, as a secure creditor, any sale or anything in the project needs to be, pay or fees before, and that's very common in project development.
So I mentioned our partners in my response to the previous question. There's another question here that says, are future projects now being chosen based on having superior partners than was more of the case in the past? This is a very exciting question, I think, because, the answer is yes. It's a conservative yes, because it's still early days. But, I think we've communicated in the past that, we announced at the end of last year our relationship with Wood. We have very regular meetings with Wood. They're structured meetings with very specific agendas, very specific projects such as Southport that we're working on together, but also a pipeline of opportunities. And Wood is bringing as many opportunities to that as we are. And so gradually we will see more and more interest. And in fact, Yoel and the team are getting directly involved in working with Wood in responding to some of those customers, even in the early stages. So, we will gradually begin to see our pipeline expand by virtue of working with these partners. The other thing is, as we work with them, of course, we build a way of working they build confidence in understanding our technology and understanding, how they can construct it and commission it in the best possible way. We understand how best to work with them, how to engage them, and how to work with them in the case of an EPC as the lead contractor and so on. So as we build those ways of working over time and we build that confidence, we will build more projects more quickly in more places. And because most of these are multinational companies, they will be taking us into markets that we would not have otherwise gone as quickly without their involvement. So that, strong ability to take us to market as well.
Yeah, but let's also not forget that we have catalyzed that interest and that demand for the larger partners by having a pipeline of projects. So initially in all this relationship, we have bought more projects into the relationship because we had relationship with smaller developers that have developed a portfolio, which a such organization will not be doing, particularly when they come into a new sector. They will not have the internal buy-in to start looking at smaller developers and aggregate a portfolio. We've done that for them, so we become also a catalyst into a pipeline that then they can use as a reference to then use their scale and their resources to then go and look at this project, attract other investors, and use the initial project that we bought into the relationship as a reference point.
There's another question here. With the energy prices up sharply, has it made some of your projects more commercially viable?
I think there are two elements to it. So first, yes, from a revenue perspective, the answer is yes, that it has improved the project IRRs and so on and so forth. At the same time, from a supply chain perspective, the costs have also gone up. And although we do feel that both from an energy price point of view and supply chain point of view, there would be stability coming into the market in the next 2 to 3 years. We do see that the impact on revenue outstrips the increase in costs in the supply chain that we currently see in our financial models.
Yeah, I think also another thing that has brought a new sense of urgency. I mean, we talked about this before. We had conversations that started a year and a half ago with corporates. The likes of it could be a Procter & Gamble, could be any company that just wants to decarbonize the industry, and it was driven by an ESG agenda. They're moving very slowly. They were exploring technologies. Suddenly, they go back in touch 6 months ago and said, we need to find a way to replace natural gas quicker. We now have buy-in. We need to find, we have a budget now to develop the first project. We need to find ways to replace, our sources of electricity. So there's a sense of urgency that has come with that situation, and is normal.
If we go back to project execution, there's a question here. What sort of specific issues are you seeing on the ground in moving projects, especially MDCs? In moving those projects forward. Are you seeing any labor shortage issues, or is this being adequately managed by contractors? I mean, I think we can comment and we can say more about the Italia MDC as an example. I think going back to what I said earlier, I think funding has been the single biggest challenge. That's the market environment that we're in right now. It's interesting, the Italia MDC, because it's in the middle of the Val d'Orcia, which is one of the most scenic, greenest, most beautiful parts of Tuscany, and indeed, part of Italy. So, which is exciting because we're going to put a very clean plant there that's going to do great things locally for the community without, the emissions footprint that, others would be fearful of seeing. So that's very exciting. But, if we look around there, it's not exactly a heavily industrialized area, such as Teesside, in the UK. And so therefore, when you go and you look for labor, and Yoel and the O&M team have been looking for labor with our partners over in Italy. And we've found, very good results. We found a very good manager. We found very good people who are ramping up right now and being trained to operate that facility. And so, yes, it takes extra effort, but it is possible to do even in the most difficult of circumstances. But I think the money doesn't solve all problems. But when you're trying to get capital projects moving, funding, right now is a key accelerator that we've been looking for.
I think in terms of the labor issue as well. I mean, from an operating point of view, as Jeff was saying, the advantage that we have, our plants are heavily automated, and we need to train anyone. Doesn't matter how which industry they came in, they need to be trained to the plant. So we have a broad range of people that we can bring in and train for that. In terms of the labor for the construction, this is something that is part of the supply chain challenges that we have, and this is why many of the large capital projects have been put on hold now, because no one wants to commit on the price inflation on the material, the price inflation of the labor.
Just looking at some other questions coming in. Yeah, it seems your biggest problem is funding. You've previously spoken about receiving interest from parties, including family investment funds, on a regular basis. Is that still interest there? Is that interest still there, or what has happened to all of it?
I can take that. Yeah. So Italy is a perfect example. Italy, we it was a small project that we did with two family offices that they could have taken the project alone themselves, and more than one. They were just wanted to get into the project, and the reason we invite them to is to get an experience at commissioning this plant, and then move into other projects and move into a pipeline, and be that risk equity that comes before we can refinance this project with an institution or sell them. And the Italian family office that is involved in Italy, we are already discussing also to refinance the project and move into Croatia and move into our pipeline. And in fact, they're also generating now pipeline and bringing projects that are very well established locally in terms of renewable infrastructure. So we'll see this as well happening, with some of the investors that we'll have in Croatia, and they'll be the same thing with some of the investors that we have in France. So that initial equity, risk equity that now are comfortable to do the development part as well, because they have seen us, they have gone through a project under the belts with us, where they can see the capabilities for us to how we also have reacted to the challenges in the market. I think that's very important. when you're looking to co-invest or invest into management or into a partner, you want to know how they react when things are not going well, and that's been a good opportunity, and that has catalyzed the relationship as well.
And just to indicate that, apart from obviously the family offices and the existing relationships, we are also increasingly seeing institutionals as well coming into this space because of energy security related issues, decarbonization related aspects, and so on and so forth. So previously, once the funds were set up, they had a very strict criteria to actually get these projects financed. Now we are seeing a slightly more flexible approach towards that, and we are going to, in the next months ahead or so, ensure that we tap that part of the market as well.
We have a question. How big is the retrofit market similar to the first French project? Is that where mass scale might sit? It's a very interesting question. Yeah. We should remind ourselves that the MDCs that we're targeting, the first two are recommissioning of decommissioned plants, and then the third, as you say, is a retrofit of another company's failed gasification technology. We'll be putting it in. Now, Yoel is far more of an expert. Unfortunately, we're having some sound difficulties with him, but there are pros and cons to retrofitting, of course, because you're not building everything from scratch. You have to get to know the existing infrastructure very, very well, and you have to look at it in detail to make sure that you replace absolutely everything that needs to be replaced and leave as much of it as is reusable as you possibly can. And that takes time in a different way than, for example, building stuff from scratch. And it takes, direct engagement of experts and so on and so forth. We still have got to renew the contracts, or I should say novate the contracts for feedstock and offtake and so on that pre-existed us. We have to go through and get an update to the environmental permit, for example, because it will be using a different technology that hasn't gone through that process yet. So you're still facing some of those things, and there are still tricks with it. If I move out to a macro, that's the micro kind of perspective, and the pros and cons of doing kind of retrofits and recommissioning. If I move out though, and I look at the macro picture, we've looked across Europe and indeed rest of the world, for example, for incineration. And we look at how many incinerators are going to start to reach end of life over the next decade or so. And if you start to look at that, that opens up the opportunity to go in and start to retrofit with gasification technologies. We've even said, why not build gasification technologies on incineration sites to coexist, so that then you have a choice of how you ramp down one technology and bring in another. So yes, that very much is an option. And in fact, we've had even recently some of the large owner operators of incineration technology approach us to begin to have these sorts of discussions as they look further down their roadmaps. We've had opportunities in France, for example, to go in and look at retrofitting some of the coal-fired power stations that they've been running there as well. So these opportunities do exist. And yes, I do think it's worth looking at it as a potential accelerator, or at least a complementary way and a new line of business for us, a complementary way of delivering our technologies. Just looking through, well, the inevitable question, are we concerned about the low share price?
Well, concern, I mean, we're obviously not happy. We're all heavy invested, personally into the company. We continue to be. I mean, we obviously find it in one way natural in the environment. Obviously we only are focused on what we're doing ourselves, but we see that it's not associated with EQTEC. It's associated to everyone in the space. In fact, we still, in terms of resilience of our plan, we believe that we are much more. We are not building, big piece of infrastructure in 5 years to then start selling equipment. We are not building 1 or 2 plants that if they slow down, everything slow down. We have resilience built into that, so we believe we are much stronger to come out of this. Our numbers, still going into the right direction. Yeah, we have adjusted revenues, but we're still going in the direction of reducing losses and increasing revenues and profit. So the time will come when we break from the pack. But at the moment, I mean, we don't see. We need to focus on, as I mentioned as well in an interview before, we as entrepreneurs and early stage companies, technology innovators, we don't have time to comment on the market. We need to act on it. We need to be able to be decisive and to, with best available data, make our calls so we deliver the strategy. This is not a next year what the share price is going to be doing. This is, in the next 5 years, be powering 90% of the new energy infrastructure required for decentralized and distributed power. That's the aim. How we get there in the next 12 to 18 months is just as quick as possible. And that will create the value required. And that's the goal.
The questions that we challenge ourselves with are regularly, and we have vigorous debates with each other and with the board at large, as well as inside with the team and with partners and so on. Number one, do we have the right strategy? Does EQTEC have the right strategy? Are we aiming for the right things? And the feedback that we've had from institutions, as well as from some of our larger, shareholders and so on, has been that they feel we have a more coherent and clearer strategy than many other comparators in the market do. And it's one that is tried and tested. We've seen happen with other technology companies, a little bit outside of our industry. So one is the strategy. The other question is, are we executing on projects as well as we could be? The answer is always no, because we can always find areas of improvement. But as I outlined those 4 areas of focus earlier, we feel we have covered 3 out of 4 of those extremely well, and we have now reconfigured our corporate center team to focus now on the 4th, which is the funding. We have launched specific projects to go out now and really ensure that we are targeting, getting deeper insights into what motivates those funders to invest in certain kinds of investments, and ensuring that we maximize our ability to be the ones who win that investment. We are operationally much slicker now at preparing to engage those funders. As I said, we have much more robust financial modeling capability, and in fact, some of probably the leading thinking in this industry around some of the financial modeling that we're doing. And we are engaging third parties to constantly challenge us with their market knowledge as well. But then we're moving that on. We're producing much higher impact presentations and pitch decks for the funders, and then allowing them very quick visibility so we can help drive due diligence, which takes time, as quickly as we possibly can. So we're operationalizing. We're not just trying to target those funders better. The way we engage them and get them on board, we're trying to reduce the risk of and increase the probability that we're going to be able to land them. So all of these things are aimed now at executing against a strategy that we still believe is right, but executing with higher precision. And I'll go back in a market environment where, but by no means is this an EQTEC challenge. Every single company we encounter is facing the same things. Every webinar I attend, whether it be with the public, with Bayes or with another part of the government, whether it's a private sector, FT-led conference or webinar or whatever, this is the discussion that whether big or small or mid-size, all companies in our sector are having, which is they're struggling to get to FID, they're struggling to get to financial close because they cannot get the funding directed to where they are.
I want to add something there as well. I mean, we've been engaged in discussion with a number of large investment banks, just initiated by them as well, because obviously, banks that otherwise would not be involved with us because of the size of the company at this stage, but they are interested because of the size of the infrastructure opportunity and the real dislocation of how far advanced we are compared to other technologies. And very interesting comments from quite senior people in the bank. They're mentioning some of the transactions that have been happening in the sector. In Europe, eye-watering valuation with not much there. And they say the issue now is that a lot of those investors have been, written off or not really being what expected. And say because people, the statement that they make that was very interesting is say people are hiring PR operatives instead of engineers. We got technology companies that go with a story and a lot of PR and not enough engineering. I mean, we need to remember as well, but for the size and the ambitions of what we're having, we are 20 engineers and another 15 people in the corporate center. We are still a very small company, but we are much larger than the other companies that are there, that they literally are, a couple of guys with an idea and a good PR.
Maybe the final question now, given the time. Please, can you explain why the recent change in joint broker?
Well, I mean, that was something that was on the cards for a long time. We are looking to, we had, great relationship with Arden, but I think we have outgrown the relationship, and we also believe that Pamela Gordon has a differentiator that is interesting about attracting strategic investors that are not necessary in the capital markets. So, we also like very much the analyst of Pioneer has a lot of credibility in the market in renewables, and and we're looking forward to the relationship.
That's fantastic.
Okay,
Thank you.
I'll hand back to you.
Yeah, fantastic. Thank you, Jeff. And of course, just to remind investors, the company can review all those questions submitted today, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. David, just before redirecting investors to give you some feedback, could I just ask you just for a few closing comments, please?
Yeah, thank you very much, Paul. Well, I continue to bang the same drum. I mean, I think we are, the whole team is working incredibly hard for achieving, a very large dream, which is being at the heart of decarbonizing decentralized infrastructure for power and fuels. We are that missing link that has been difficult to do the transition between fossil fuels and alternatives. There's no other pathway than gasification to turn out a low-value solid into a gas. Doing that successfully is already downstream proven in petrochemical. We just need to replace that fuel that will be feeding that system. That's a massive task. That's a task that we have. We are going against the very established, obsolete infrastructure, the status quo, but that change is coming quickly. I mean, there have been delays because of the current market conditions for everyone, but that is something that is significant transformation to the market, is something that we need in the environment. It's something that we need to address very quickly, and it's the disruption that's going to make us being able to be self-sustainable with energy security, and we are decarbonized future that's going to be relying a lot into electricity. So, all I want to say is like we have a great investor base. It's still very much. We have a lot of retail, but we have retail investors that are more prepared and more informed than some of the institutional investors that we have had. And we appreciate the trust. I know it's painful to be an equity holder of anything in this environment. It's painful for us, as much as it's for you. We just need to continue to plow ahead and deliver the strategy and deliver the outcome that we are set to deliver. So for all of that, thank you for the trust. Thank you for the critical comments. And, we continue to be here adapting and incorporating those into our strategy.
David, thank you. And thank you, Jeffrey Norman as well, and also Dr. Yeo on the line. For your update today, can I please ask investors not to close this session? You should be automatically redirected to provide your feedback in order that the management can better understand your views and expectations, which I know will be greatly received. This only takes a few moments to do so, so do please spare the time. On behalf of the management team of EQTEC PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good morning to you all.
Thank you.